Welcome to the Dividend Talk podcast, episode 62. Famous quotes that shape our investing philosophy. Hey guys, welcome back to another episode of Dividend Talk. This week, we're going to have a conversation around famous quotes and how they actually shaped our investment philosophy. Our news of the week will involve football. We'll also talk about the Fed and their stance on interest hikes. We'll review the top 5 positions from one of our listeners. We'll answer some questions from the community. And last but not least, European DGI will give his stock pick of the week. It's slightly different to what you're used to before, so stay tuned for that. As always, if you never want to miss a show, please follow us on Facebook or Twitter or your favorite podcast player. See you on the inside. Hey, European DJ. Long time no speak. How have you been?
I've been good. Thank you for asking. It's been, the stock market kept on going. There was a lot going on again in the news. Yeah, but how about yourself?
Yeah, I've been kept quite busy. I've told you before I got a promotion at work, but with promotions come longer hours and more responsibility. So I haven't. I have been non-existent in the last 2 weeks. So I'm actually glad we had a little break last week. I know we had Dividend Athletes Part 2. If we didn't have that, I probably wouldn't have been able to do the podcast anyway. So it worked out quite well. But I'm looking forward to this week's show and getting back into the world of dividend investing.
Yeah. So maybe it's also good to mention to you, because what you are also missing out on based on last week is that our Facebook page started to grow a bit. So more and more people are starting to find us on Facebook. So to everyone who's listening that has not signed up yet to our Facebook page, just look up Dividend Talk, follow the page. But there's also a Facebook group linked to it. So if you go to the Dividend Talk group and sign up yourself there, then that's the place where we will also be asking questions going forward, like top 5 portfolio positions or questions from the podcast. But also just general engagement. If you have any questions for us, just register yourself to that Facebook group, and then you can directly engage with us. I know we're a lot active on Twitter, but we will be more and more active also on Facebook.
Nice. So we're going to talk a little bit about the news. I believe there's something with the Fed and interest rates. This seems to be popping up quite a bit, doesn't it, about the Fed and what they're actually going to do with these interest rates.
Well, yeah. So yesterday, Jerome Powell mentioned that they will start tapering by the end of the year, but not yet raising the interest hikes. And for me, this is really interesting because I felt like they threw so much money last year at this pandemic. All what they did in America with almost this how is it universal basic income that they effectively supplied to everyone. And I really felt that this was driving a lot of the uptick in the rebounds that we saw in the stock market as well. All this cash flow coming into people's hands that they deployed to the stock market. But at the same time, Fed was just buying up everything they could. And what they're saying is that they are going to gradually slow that down now. And this is really interesting for me because it will be the first time since the pandemic that we will see if the stock market can at least live a little bit on its own. Because for me, it's not a free market at the moment, right? It's we talk a lot sometimes about China and communism. If you think about what the Fed is doing, it just put how I say it, just put a put option below the market that by buying everything, it's like a giant stock buyback, almost you could consider it. So there's a floor in the stock market because of that. So what they're telling us now is that they are going to gradually take that floor away from the stock market. That's how I look at it. So I'll be really curious to see if the addicted people can now live on their own a little bit, right? And that's why I wouldn't be surprised if this starts happening and it hits also the news that we will see a small correction. I don't think anything big yet because there's still too much governmental support there in the stock market. But it will be interesting to see if it creates some volatility there. And, volatility is our friend. So
We like volatility. Yeah, I can certainly see that the sentiment is starting to change on Twitter. There's a lot more noise about stocks being overvalued, and at the same time, if the Fed are starting to take away this floor, we should definitely see some sort of correction. I would expect to see it, but we know I've been wrong numerous times, and the opposite has
yeah,
happened. I think you posted something on Twitter. We've reached, is it 52 all-time highs this year
yeah,
alone?
yeah.
It's not a record. I know we've hit 77 in one year before, but it certainly shows you how strong the market has been, and I mean, who knows what's going to happen, but it's something obviously to keep an eye on. And look, the Fed have everything in their control at the moment, so us Europeans need to keep an eye on them across the water.
Exactly. And what we always say, right? If America sneezes, then Europe gets a cold. So it's probably the same here again.
Hopefully they're wearing a mask and we don't get a cold too bad.
Yeah, exactly. But the next one is maybe a little bit more also for some of our listeners. Manchester United bought Ronaldo from Juventus. Now, we know you're also supporting the Reds. I mean, the other color of red. So, what are your thoughts about this?
I mean, he's 36, I think, is he? He's in
Yeah,
the twilight years. I watched him at the Euros. Yes, he was the top goal scorer, and he's a fantastic player. But he's not the player he was. He doesn't have the legs. His game has changed. I honestly think Manchester United don't need attackers. They have plenty of attackers. So they're a good team. They'll be up there for the title, but they're not going to win anything. And Ronaldo doesn't change that for me. He's just going down a shitload of money, and be on his way in 2 years. I mean, it's. I don't think it's something for the future. They're trying to win something now. I don't think they're thinking of the future with something like this. And look, fair play to them. Like look at PSG with Messi and all the players they brought in. They haven't played yet, so
yeah.
let's see how much game time he actually gets.
What I like about this move is that I always appreciate it when homegrown players, which Ronaldo kind of is for Manchester United, return home after their career. And this is how I see
Yeah,
it. And he still returns home as a big star. And that's what I really like about this. So I hope that he can be an example of some of the talents at Manchester United that are maybe missing leadership, because after Giggs, there's not really been a leader. Okay, maybe this guy from Sweden, Ibrahim, what's his name?
Ibrahimovic.
Ibrahimovic?
Yeah, yeah,
Ibrahimovic. But there's never been really a leader. So hopefully he brings in a little bit of leadership there. But like I mentioned also earlier, like for me, this is also the classic Buffett investment, right? A cigar butt acquisition and trying to get a last puff out of it.
yeah.
This is also Ronaldo for Manchester United. So I hope they will sell a lot of jerseys and that they earn some of this salary back.
No, no, I don't want that. But what I have to say is that I'm glad he didn't go to Manchester City. I mean,
Yeah,
he's a Manchester United icon. He's a legend. I mean, you risk losing all that for money by going to, because money is not an option for him. He doesn't
yeah,
need the money. He could have easily went to Paris Saint-Germain or numerous other clubs and got a lot of money. To go to your biggest rivals in the same city, it would have been
yeah.
horrendous for him, I think. So I'm glad
Mm-hmm.
he didn't go there from a professional standpoint. Um, but look, I don't really like Manchester United, so that's about as far as you're going to get from me.
Okay, great then. So let's switch quickly from this topic before you get annoyed. Today we have a little bit of a different kind of topic than normally, because we had all the violence of earnings season in the last few podcasts. And today I really thought it's good to take a step back a little bit and look at our investment philosophy and where it originates from. And I don't know if you're like me. I've been reading a lot of books in my early days before, when I really started to shape myself as an investor. And there are always these investor quotes that stuck with me that really made me think, wonder, ponder about things. And they've really shaped my investing philosophy. And I took away the other day from you that's kind of similar. So today I would like to just discuss some of those quotes and why they made such an impact to you and to my investment style, and maybe with some examples.
Yeah,
So I know we have prepared this a little bit from that point of view. And the interesting one, that's one of the things that you selected out there, is the time to buy is when there's blood in the streets, from Baron Rothschild. Could you elaborate a little bit on why this quote is a bit at your heart, let's say, as an investor?
Yeah, it's something that I tend to follow as an investor and as a person, I suppose sometimes, because I'm not usually one to follow a crowd. I feel if everyone is doing something, it's not always a good idea. It's not always a good idea, and we've seen this in numerous different occasions, and even growing up, always been like that. Like I was with a group of friends, they've all did substances and stuff that are not good for you. I've always stayed away from that because in my head, I'm like, I'm my own person, and I stick to that from an investing philosophy. And usually, you'll see that with some of the companies I buy, like Walgreens, for example. I bought them when everybody's saying, nope, don't buy them, stay away from them. Did the same at Cisco, Intel to a degree, even though I've later sold them at a higher price. And usually, lots of people get fearful way too easy. And we look at Alibaba right now at the moment, right? And I have to give a disclaimer here. I know I said on this show about 4 weeks ago I wouldn't buy Alibaba, but I think they've dropped so much in price at nearly 50%, I think, since their all-time highs. I bought 20 shares of them this week at around 150 $50. I bought them. And my thinking here is that what has changed in their fundamentals? Yes, I know China poses a risk, but did they pose that much of a risk that it warrants a 50% drop in price? So people are scrambling, they're selling, and I'm thinking, okay, the risk and reward here suits my tolerance, first of all, and I think that the reward outweighs the risk. So while other people are selling, I'm there buying. So that's kind of a philosophy that always resonates with me. I always look at companies. Do I see, has anything changed? Do I see future growth? Do I see something in them that has changed, or can they actually propel? And I'm happy to buy while others are selling. So the coronavirus was another good one, I think. And,
Yes, definitely.
and we have said that we will buy when it dips. I think it's easy for an investor to say that, but it's actually when it happens, it's not as easy. And that's another good time that I can give as an example that I bought while others were selling.
And is this also this, let's say, this being different than others and looking at other things? Is this also why you're a dividend investor? Because what stuck with me from Ian Lopuk when we had him on the show is like, dividend investing is trying to beat the system. And that also, although he's not a famous investor yet, maybe that there are many books written about it, but he's a YouTube star, so to say. And it really stuck with me as well. Like, yes, that's true. I'm also trying to beat the system. Yeah, because the whole system is rigged against early retirement. Yeah,
Yeah.
they need us to work till 67.
And do you know what? It probably subconsciously is. And within Ireland, and you notice that dividend investing
Mm.
is
Yeah.
not mainstream over here. So I'm kind of out in the loop here. There's a small niche of us that do that. So that's probably something psychology as well, where everybody's buying houses over here, everybody's in the index funds over here. And I'm like, no, that there's a different way. Not may not be a better way, but there's certainly a different way, and a way that suits me a lot better than those. And that's why dividend investing is at my heart.
Cool.
So maybe I might pick one from you. I see you have quite a few, but one that I would like you to talk about is, in the short run, the market is a voting machine, but in the long run, it is a weighing machine, by Benjamin Graham. Why does that trigger you?
I had to learn this one, and I only started to understand it later. But why it triggered in me, it's a little bit similar to what you just said. It's not necessarily about blood in the streets, but I'm so I'm a dividend growth investor as a primary investment philosophy, but I'm also strongly attached to value investing. And for me, this is probably more like even a value investor's quote. What I've noticed is that if I do my due diligence and my analysis, there comes something out of it that tells me, okay, this is approximately the range of value of a stock. And then I look at what the stock is trading and I think, like, what am I missing? What is wrong? And I start looking maybe at the risks that are being addressed elsewhere, and I think like I don't see these risks. But what's happening all the time is then that, for instance, think about Danone last year. Yeah, it went all the way to even to the mid 40s. It has been trading in the low 50s for a long time. And I thought, like, well, the only thing that's really an issue here is the water business. But it got hammered and hammered the stock continuously for a long time. But the earnings and such, they tell me a different story, and the earnings power, the underlying earnings power, and that's why this quote resonates a lot with me, because from a value investing point of view, I had the same with Microsoft in the beginning, or with Apple. Apple was trading at 13. Everyone said it was dead, but I was looking at the numbers, and I was looking around me and thought, no, it's not dead. It's blooming, and the services that they are selling, it was trading at 13, and I felt like, what am I missing? What is wrong? So this quote, it really reminds myself, like, okay, and within the first year, you will it might be that nothing happens and that you feel like this stranger, that you're all the time doubting yourself. But in the long run, it's really a weighing machine, and that's what I've been learning over time. That suddenly you get those pops on the earnings, that they suddenly pop up 10-15%, and that's where your validation comes from. You might have had it right. So it's more related to value investing, but it makes me always feel good that after 1 or 2 years it finally comes, and then you still get your 25% annual growth or something like that on these stocks.
Mm. I think Apple and Microsoft are two that kind of spring to mind when I think of something like this. I remember you speaking about Apple. I believe the iPhone was dead, or so people thought,
Yeah,
and they were starting to sell off. And I remember you saying that nothing has changed. They're still selling millions and millions of these units and releasing new units, and now look at Apple. So it's certainly correct that in the short term, it is certainly a voting machine. I'll go back to Alibaba.
yeah,
That's what's happening right now at the moment. You go back 10, 15, 20 weeks ago, the sentiment about Alibaba was a lot different. They were up around $300, and
yeah,
everybody was screaming, buy, buy, buy. We have some turbulence from China, and those same people are now screaming sell. So
yeah,
it is a voting machine. It's like a popularity contest sometimes, and sometimes
yeah.
you are not so popular, but in the long run, you graduate, go to college, and become smarter than these people and earn more money. So you don't need to be popular in high school.
I,
So
exactly. And maybe this then is also a quote, I said, that you mentioned, and it's far better to buy a wonderful business at a fair price than a fair business at a wonderful price, from Warren Buffett. Is this also related to it?
yeah, I mean, you can tie a lot of quotes in together, can't you? They all
Yeah,
have a similar theme on this. And look, I suppose we want, as an investor, you want to make money. You want to maximize your returns. We focus on cash flow, but you still always want price appreciation as well. If you buy a company that's completely overvalued, and that's why I'm struggling at the moment. I'm looking at companies that are 32 times earnings. Where does that go from there? I can only see down. I mean, I can't see earnings going to 50 to 100 and sustain. So I can't see the growth. So for me, I think it's. I mean, there's lots of wonderful companies out there that we know, but their earnings are just too high. I would love to own Visa. I would love to own Apple at the moment. I would love to own loads and loads of different companies, but I just can't buy these companies right now because they're not at a fair value. And maybe I'm a little bit like you. I think dividend investing and value investing are kind of hand in hand, aren't they? Really, you want to buy companies that are at least at fair value. You don't want to be
yeah.
overpaying. You want to make as much money as you can
You need
from
your yield.
exactly, but you want to make as much money as you can from dividends and also from price appreciation. So I think a lot of these are intertwined. I mean, you have price is what you pay, value is what you get. Again, Warren Buffett. That ties into the exact same mold, I think, as previous two quotes.
But there is a difference here that I had to learn, because I would argue that I made several mistakes in the past because I was looking at cheapness, yeah, at mediocre business. And for me, Tupperware is a good example. Tupperware, for me, by all metrics, was undervalued at the time. but it was just a broken company. And I was thinking, okay, we had in Europe and Germany all these Tupperware parties. I mean, people in Asia must love it. And I really bought into the story of the CEO, who Ricky Goings, I think his name was. And for me, this associates me now with a charlatan name. But for me, it was a typical example of a undervalued company with poor to mediocre business quality. So what I had to learn to was focus much more on the underlying quality of the business, and then not be too tough on the margin of safety that I need. Because without that learning, I would have never bought Microsoft and Apple. Yeah,
No.
because usually you get them at okay. Apple was a bit different; it was clearly undervalued. But for me, when I started accumulating Microsoft, it was fair value at the time. So there has been a shift, and it's funny because when I read Warren Buffett's biography, he mentioned actually going through that exact learning, and that's something he had to learn from Charlie Munger. I had to learn it from Warren Buffett by studying his material, but still, it had a time lag of a year before I really started to understand what that was when I analyzed my failures.
Yeah.
Uh, And
But
and yeah,
yeah, I mean that's the one of the hardest elements for investors. There's a difference in cheapness and value, and
exactly.
just because a stock has a cheap price doesn't mean it's value. I mean, it could be a declining business. We look at IBM, for
Yeah,
example.
yeah, yeah,
We could look at IBM and say, oh, they look cheap compared to where they are before. Yes, they look cheap, but it's a declining business. I don't see that as value because I don't see where the value is going to come in
yeah,
their future prospects. So that's a key difference. And I think one of the best things for investors to do is to write down what the key drivers for growth will be.
yeah,
Is there anything? Is there anything? What is actually going to grow them? And then
yeah.
decide then if you're willing to pay the price for that.
Probably if I would have been in my first year of dividend growth investing, I would have bought IBM now.
Yes, yes, and probably me too. Me too. I
Yeah.
mean, look on paper. Let's look at it. They have a increase in history of I don't know 20
Dividends.
yeah
Yeah,
20 years. I mean, their last one was good. Their earnings always seem positive and upbeat. They know how to
yeah.
manipulate the numbers, whereas the top figures look good, but you dig deep underlying and they look bad. So
It's rotten. Yeah,
you can see why investors get sucked into that, and they're a dividend aristocrat. That's where new investors always start. The new dividend investors always start, and you see that they're a name that everybody will know. It's so easy to get sucked into that.
yeah. Well, maybe there's still like there's still one that I wanted to really call out, and that's the one from Chamat Palihapitiya. And he mentions good investors have to choose how to allocate their mind share with the precious capital they have. This one resonates so much with me for the one simple reason. I often get a lot of questions about what I think about certain stocks, and my most of the time my answer is I don't know. I don't have studied it. I haven't studied it. And this is also something that I find really important to myself. I know that I have, let's say, 6 hours per week to study companies. So I need to spend that time really, really wisely. And going over in this 6 hours over trying to understand 8 companies doesn't really give me a lot. So I rather put this 6 hours into one single company than putting on a lot of different things. And this quote has really struck me when I heard it from him as something like, I should probably even need to double down on it. I want to understand what businesses I own initially, because then later when I see the quarterly findings, and to your points, I've got my notes on what during my analysis, the 1, 2, 3 items I would need to track. And then I can just on a quarterly basis track them. And if it goes according to my thoughts, then I'm good. If not, I will probably need to dive a little bit deeper because it saves me so much time later. So I kind of automate my own analysis after that. So being really conscious of how you allocate your time is really important for me, because otherwise I could probably just better purchase ETFs.
Yeah, but we've put ourselves in that position by running a blog, running a podcast around dividend stocks. So people are naturally and quite rightly so are going to ask us questions about lots and lots of different companies and probably would expect us to know the answer. So for example, we got a listener question in today about car. And we've both decided to push that out to next week because we don't know that company well enough to give an opinion on it right now. We just don't know. It's not possible to know every single company.
Yeah,
But it is nice that people ask us these questions because now we get to go out and we get to look at a company.
exactly.
We might find something new. We had Dividend Athlete on last week, and he gave us a really, really great stock pick. DIC assets. I've been looking into them a little bit, and I'm probably going to buy a little bit of them. On my own, I would never have found that company, and I never would have
Yeah,
invested in that type of company. So it is nice that people ask. I won't always know the answer, and I'm not going to bullshit anyone and say yes, I know this, and give some fairy answer about them. So
yeah.
I'm like you. I have a small amount of time. It's getting a lot smaller, so I like to just compress on my own companies first, and then when people come with interesting ones, start to build up knowledge gradually on them.
Yeah, no, and that makes sense what you say. And look, if I study one company every 1 or 2 weeks, let's say 2 weeks, I'm still studying like 25 companies per year. Do that over 6 years of investing. You build up quite a knowledge base around companies, right? And including even the listener question, because yeah, we don't just give any answer. We always do our homework first.
Yeah. And what about from Sir John Templeton? This time it's different.
Yeah, when I hear that, I tend to agree with Sir John Templeton that it isn't different. It might be different momentarily because of the sentiment, or let's say like that, stock market is overvalued. And we would say, but this time it's different. We heard that also compared to the stock bubble in 2000 with the tech stocks. People say, oh, this time it's different because now there are real earnings below it. Well, maybe that's true. I think most of the people that give me that answer were kids at the time,
Yeah.
so they have not lived through that period. Secondly, it's not necessarily the earnings that people refer to, it's the valuations that people refer to. Look at Lemonade, this insurance business. Where is it now? Yeah, there. Look at Wirecard.
Yeah.
There is so much in the stock market that's just wrong, that I totally don't believe it's different. Every crisis has its own narrative afterwards, like the global financial crisis. Nobody knew, probably, let's say 99.9% didn't know about the credit swaps and everything that was going with these mortgages. So it all gets the same narrative. But for me, there's just one simple reason why the stock market is so high, and that's because it's a government controlled stock market at the moment. As soon as the government cannot control it anymore, I think shit will hit the fan. And then we will say afterwards that this time was not different.
I actually learned this the hard way through crypto investing, and I know I
Mm,
spoke before that 2017 and that big run up at the time Bitcoin. I was involved. I had XRP, which luckily I got out of, but I took some of that money, and I don't think I've said this before, and I put it into a company called Tron, right? And it was owned by Justin Sun, who was a Chinese guru who was going to actually make us all millionaires. And like a lot of people at that time, we were greedy. We were putting money in. We were expecting everything to just 10x the whole time. And that was one thing that was said an awful lot. So every token or every kind of own currency had its own group that were bad mounting other groups and stating why, okay, this time is different than this. We're going to explode. We're just waiting for this to happen. Things that happened what they said, but it never exploded. And this went on for about 2 years. I was in another one called Spectre. So Spectre and Tron, and I was bag holders on both, and the price went nowhere but down. So I learned that really the hard way. Like this time is different. It never really is. History is always repeated. And as you said, it may not be instantaneous, but there's always cycles, and you will get caught up. And I think investors and people in general, greed is such a hard emotion to overcome, and I think that's the
yeah.
failure of most people. They want that easy money. They want to get rich quicker. They want to reach
Yeah.
financial independence quicker. But I think the
Yeah.
key thing is to have a plan, stick to that plan. If it takes 10 years, stick it out 10 years and try not deviate from it. But certainly have a look at history, because you'll be surprised how often that it does repeat.
Well, then in that case, we cannot better close this segment than to look at Howard Marks' quote, because he said, "There are old investors and there are bold investors, but there are no old, bold investors." I think it sums it up, just what you said.
Yeah. Although Warren Buffett is an old, bold investor.
Literally, maybe.
Literally, yeah. But
Yeah,
no, I think he's right, and I suppose risk tolerance is key here. I mean,
yeah.
as you're younger, take all the risks you want in the world. You have lots of earning potential, but as you get older, you start to learn that that earning potential will dwindle. If you're in a 9 to 5 job, for example, the older you get, the less
Mhm.
employable you might be. So your risk tolerance has to change, and that's probably why dividend investing suits probably an older generation rather than someone in their early teens or early 20s.
Yeah, definitely. Okay, this was really interesting for me, EMF. Also nice to talk about this topic with you. Okay, so let's close this segment down and let's go to the portfolio review, the new segment that we started in this show with Dividend Athlete. And there was Ritz Wildevank. I'm not sure where he is from, but he asked us to actually review his portfolio. So what I will explain now is his top 5 holdings with the percentage allocation and what his portfolio goal is. So his top 5 is Munich Raiffversicherung. It's a 10% portfolio holding. The second one is Flow Traders, which is an 8% portfolio holding. The third one is Novo Nordisk, which is a 7% portfolio holding. The fourth one is SSE PLC, an energy company from the UK, with 6%. And then the fifth one is Dover Corporation, also with 6%. I believe this gives us a total of, what is it, 36 or 38%, 37% of his
Yeah.
top 5 of his complete portfolio. And his big portfolio goal, is a growth of 20% per year. What are your thoughts on this portfolio?
My first thought when I saw that goal was, wow, that's a quite lofty goal, 20% per year. And looking at what he said afterwards, that he's quite worried about potential significant pullbacks. Um, I think it's clear that he's maybe looking for capital appreciation here more so than dividends. I don't think he's expecting 20% from dividends, or if I'm wrong, let me know. Looking at those companies, I don't see 20% per year coming from those companies in those. There are some quite nice companies, so I do like all those companies. I don't know Dover too much. I had a little look as we are going. They're an industrial company, which I have no industrial companies in my portfolio, so I might look them up. But certainly the rest of the companies, Flow Traders, I had in my portfolio. I typically buy them come before dividend, and I don't hold them long term, but they are a good company when there is volatility in the markets. Um, as Rich said, he's expecting a significant pullback, so that will certainly benefit them. They had a huge dividend yield last year; it was 18%. But if you look at their dividend history, it's scattered. It's not always 18%. Sometimes it could be as low as 1 or 2%. So it's something to keep an eye on if you're expecting increases in dividends. Novo Nordisk are a great company. We've spoke about them numerous times. SSE is an interesting one. It's a utility company from the UK, or not a utility, energy company. And it's a company that I've heard quite a lot about. They have a 5% yield. PE ratio is a little bit high at 17, but I think it's a quality company. I was just checking their net earnings and stuff has been rising over the last 5 years. So they're obviously doing something right. Overall, the structure of this is far different than the typical one we've seen over the last couple of times we've done this. Lots of people have defensive portfolios, myself included. This is certainly not a defensive portfolio, and we can see that he's out there to try and get his 20% per year. I'm looking at the dividend yields here, and they're a mix. He's certainly not yield chasing, so which is good. I feared when I saw that goal, somebody might automatically go for high yield companies. He has I think a nice mix here. We know flow traders will fluctuate, but other than that, his average yield is about 3% on those companies. So I think it's a nice portfolio. I'm just concerned about the ambition of 20% per year. If that's purely from looking from growth without adding money to it, it's quite lofty and might, I don't know, promote bad decisions and chasing companies maybe that you don't need.
Yeah, I think, I mean, if I look at top five, I really, really appreciate that this is something different than we
Yeah,
see. And of course, I love his number one position, the insurance company. I don't think that this insurance company will ever give 20% growth unless you're a pure investor for capital appreciation, because it's a really slow growing company and it's not a front leader in digital transformation in the insurance industry. Novo Nordisk is actually the only company that I could imagine growing at such a rate, but then it needs to start outperform themselves going forward based on historical norms.
but and they have a PE ratio of 32, I think, from
It,
Morningstar, which is
yes, yes,
huge.
but I don't know when Rit started investing in here. Maybe
Yeah,
he bought it at 400, while it's now at 600. Then he clearly got already his 50% gain here.
yeah.
So but I think Novo has as the one that comes closest to my mind with such earnings potential, and I'm talking then about earnings growth here of 20% per year. What I wanted to give Rit some feedback on is he mentioned that he has only half of his net worth currently in the markets because he is afraid of a potential pullback. And here I would like to share something because I had a war chest for a long time. I still have it a bit. But the first time when there was a dip, it's not easy then to pull your war chest and go all in. And I think what my recommendation would be to Ritz is to study market corrections, please. Take some time to study what happened in 2008 and 2009. Study what happened during the pandemic, and start looking in the theory of I think Ken Fisher about the falling knife principle, because it's really really hard under fear to double down on companies. You need to have a lot of cold blood and conviction in what you're buying. So my recommendation would be is do your homework now to prepare a list of the companies you really really want to have at any cost, that also are out of the blast zone during a market crash. So it is clear for me, for instance, during a pandemic, if nobody's flying, you don't want airlines, you don't want cruise ships. During the financial crisis, great financial recession, you didn't want to own banks and anything that comes close to it, but then focus on the Microsoft or the other companies that will are out of the blast zone. But please study that now, because I've heard people in the past saying, I've got a war chest, I've got money on the side, and they were scared to put the money in during the last pandemic. And in that case, I would really say stick to and that's my philosophy then, stick to the um, time in the market beats timing the market principle. So that's the only really feedback I wanted to give here on that quote, because portfolio wise in top five, I would still say, think about companies like Home Depot, Starbucks here as well when the time is right. Clearly, for instance, Starbucks is definitely overvalued for me. I also don't like their balance sheet too much, but this is a company that can still grow earnings with 20% per year. I mean, if you go to Europe, they are only mainly in the big cities. This is not like in America. There's no Starbucks on any corner yet. I mean, we have 3, 4 McDonald's in the neighborhood here. There's no Starbucks in the neighborhood. So from a penetration point of view, Starbucks has still 2 decades of growth ahead of them, in my opinion. Focus a bit more on those companies, but I do assume that the accumulation of the current top five is a result of the valuations that we have seen probably in the last two
Yeah,
years. So
yeah.
be prepared for a stock market crash then.
We're on the team of famous investing quotes that inspire us, and when
Yeah.
I heard you talking there, it reminded me of one from Peter Lynch, which he said, far more money has been lost by investors preparing for correction than has been lost in the corrections themselves. And I don't know how true that is, and it could be wrong, but I mean, there is a certain sentiment to take from that, and I have both said, well, I have said, I think since the beginning of this podcast, we are now 62 episodes, a year, nearly a year and a bit in. I've been waiting for a correction, and if I had a sat by and not bought anything, I would have missed out on huge gains, particularly the likes of Microsoft and Walgreens and companies like that. So it's very hard. I get it. It's very hard to invest in all time highs. I think the dividend guy, he's a Canadian blogger.
Mhm.
He had a similar story where he took out money and he invested in 2018 when a similar sentiment was there, and he seems to be doing quite well. So maybe reach out to him and read his story and see how you feel and take it. Obviously, don't invest it all in one go, but just as European DGI said, is build up your foundation companies and maybe just start putting in a little bit of extra at a time into those. But I completely understand. I have a similar mindset to you. It's just I'm sticking. I have my plan of investing every month, so I stick to that.
Yeah. Yeah, so for me, I'm spending everything I can based on my monthly cash flow, but I'm also withdrawing from my war chest because I don't, in my opinion, I need a really, really small war chest, like maybe 5%. That's it for those occasions, because for the rest, the money is just not having any return, and it's been eaten away in the last 6 years.
Yeah.
Really simple. Hey, thanks, Ritz, for having the courage also to share your top five portfolio. If anyone is interested for next week, please come to the Dividend Talk Facebook group, share your top five, and you have a high likelihood that we will discuss it in the upcoming Dividend Talk. So maybe let's go then now to the next section. It's the listeners' questions. We will run a little bit faster through it probably than usual because of the timing of the podcast as well. So Phil's first question is about insider trading. So EMF, do you look up insider transactions when you analyze stocks? And if yes, what was an example that surprised you recently?
Not particularly. I don't really look up insider trading. Sometimes I will at the initial stage of looking at a company in my portfolio, but I haven't. It's not something I've looked up in a long time. I don't pay
So
too much attention to it. I know you might do.
I had one time I paid attention to it. It was General Electric at $17 when John Flannery said no, started buying shares with his whole board of directors, and then it plunged to eventually to $6. So I burned my fingers there. We'll never look at it again. It's not. It is really more like a management quality question than an insider trading question, because in this case, I think John Flannery, either he was too naive and believed in his own BS, or he was trying to give a market signal to prop up the share price in the hope that his options would expire positively.
Hmm.
So I'm not looking at it anymore. I don't take it into consideration at all during my analysis either. I don't trust the CEOs most of the times for this.
Very good. Okay, ESET has asked us, have you built up your war chest again, or are you low on cash reserves? He's thinking about raising his cash stash a little, but on the other hand, he's reminded of the wise words that a bubble can last longer than we can stay afloat.
I think we just discussed it. So I can tell you my war chest has been way too big because I got a bonus this year that I didn't invest yet. So I need to get rid of that money now, and I'm over deploying. I'm deploying now more money than my monthly salary gives me at the moment in the stock market to slim it down. It's just too much that I have at the moment.
My war chest has been sincerely depleted this week. I know I said in the dividend day chat that my car out of the blue went away. So we've got had to buy a new car. I
Yeah.
don't believe in loans. I don't believe in any of that. So we're buying it purely in cash. That was cash that I had earmarked for investing, but I need a car. So that comes first. But I still have money there, but I'm deploying bit by bit.
Okay, then the next question is from Thiago Diaz, and he says, given Microsoft and other high multiple stocks have very high PE ratios, are you concerned about multiple compression in the future? Even if they make all of their growth expectations, wouldn't that result in lower compounded annual growth results returns?
Yeah, you're right, and I am concerned about it, and I think I've spoke. That's why I find it so hard to invest in these high quality companies, but with earnings that are so far beyond what I'm willing to pay. I mean, it's a tough one. If it goes back to Warren Buffett's one, isn't it? Price is what you pay, value is what you get. And if you're looking to make as much money as you can and total returns, buying at high multiples is not a good idea sometimes.
So for me, it's more of a question of discounted cash flow analysis and the assumptions you take. So even if a company has a 30 PE, like Microsoft had at what was it, at $120,
Mm,
if you believe in the growth trajectory in the upcoming years of 30%, and they are doing more at the moment even, then that might be still a really good buy. But this is not for me a dividend growth investor's question. This is a value investor's question. And here I can tell you, I will not sell Microsoft at all unless fundamentally something gets broken in the company. The one mistake I made was selling McDonald's at $120 because I thought it was overvalued. So I'm not doing this kind of stuff anymore. I buy with the intention to hold, which rather means that my portfolio has been outperforming from a price appreciation compared to a dividend growth point of view and earnings growth. So yes, there is a bubbly thing in my portfolio as well, but I focus on the dividend income. And so this for me, this even I'm not going even anymore through the thought process of my Microsoft shares are overvalued because I don't intend to sell. It's not my investment strategy.
cool. Thanks a million to all the guys for their questions. I did mention we had another question on Carrier Global CARR, but we will do our due diligence on that next week and answer that. So with that said, we might move on to our stock pick of the week, and I think you're up this week, European DGI.
Well, as we say in the Netherlands, you took the grass away from in front of my feet because my stock pick of the week is Alibaba. And it's not a dividend paying stock. I realize that. Um, but we're always looking for value as well. And 10% of my portfolio is in non dividend stocks, typically more tech related, just because sometimes I guess it belongs more in my circle of competence. So I've got Google, I've got Facebook in my non-dividend paying part, and I added Alibaba already a few weeks ago at 210, and I've been averaging down all the way to where it's now. Every time I buy like two, three, four, five stocks, let's say, when it drops another 5 to 10%. And I mean, for me, Alibaba is just too hard to ignore at the moment. I have no doubt about their earnings power and about that their earnings are real. Yeah, because that's one of the things that you hear a lot here. They've been around already for, I think, for 20 years under these circumstances, also with their listings and everything. Yes, Chinese government is putting regulation in place which we need to discount for. That's why we cannot compare Alibaba to earnings multiple of Microsoft or Amazon. We can't.
Mhm.
But having a forward earnings multiple of 16, that's what we are really talking about. For a company that's growing approximately 20 to 30% per year, they grew sales last year in 34%. Yeah, that's just insane low for me. And in my opinion, that effectively China needs to take the company out of business. I'm not talking about a delisting here, but out of business. And I don't see this risk at all. So for me, putting a little bit of money into Alibaba at the moment to nurture my value investing is like really a no-brainer for me now. So I own shares at the average price of 198 now. And if it drops back to 150, I will probably try to lower my average cost price in Alibaba because I believe it should be trading at least with the discount of the Chinese government at around 230, 240 at the moment.
I, I I've started to write a blog post, my monthly review, and I'll let you read what I've wrote on Alibaba. But my target price was 245.
Oh,
So
so we're
it's
not
quite,
way off from each
yeah,
other.
quite interesting. But I will sell if they get to if they get to 245. That's a hard stop for me. I'm selling at that price. This
So
is not
my
for me a
yeah.
buy and hold.
Yeah, so for me, I would sell it around 300. That's my sell target here, because if I sell a value stock, I want to sell them when they are overvalued, not at a fair price.
Yeah,
But like Facebook, I thought originally it was $250. It kept on growing. I reevaluated my assessment, and now it's at 300 something. I still hold them because I still think it will grow further over the years.
yeah.
Might happen the same with Alibaba. It's not like it's fixed. I will keep on reviewing the annual reports and take it from there.
Cool. Nice stock pick, and nice that it's different this week from our usual dividend companies. So with that, that's the end of the show. Thanks a million for all the questions, for the stock pick, European DGI, and to all our listeners. And we hope we see you all next week.